Great, Daniel, thank you. It's a pleasure to be here, a pleasure to join you. Sophia, and to the Moeka team, the Plug and Play team, and to everybody listening. It's a pleasure to meet you and be with you. I just want to start and tell you a little bit about me and a little bit about our vantage point. Then I'm going to turn to the topic at hand of what's happening in the world of transportation and technology. So first of all, a little bit about me. I'm a founder and entrepreneur. I started my first company long before there was a plug and play. Maybe a plug and play could have helped me. But I started my first business over 20 years ago, a company called Threeplex. It was a SaaS TMS company, transportation management systems. We're using the internet to help automate what logistics companies do. Venture-backed, raised 28 million, sold it. It's now a small part of IBM. And since then, I've had the opportunity to found multiple companies, advise on and work on over 50 deals in the transportation and logistics arena at my investment bank, BG Strategic Advisors. And then over the course of the last decade at Cambridge Capital, investing my money and that of our partners in a string of companies in the world of logistics and technology. And that included XPO, Grand Junction, which we sold to Target, Bring and Last Mile, SaaS, Reverse Logics and Returns Management, and a host of others. So I have the privilege of getting to work with a lot of great people and great companies throughout the world of supply chain and technology. And one of the things that we do, and for 15 years, up until this year in person, we've had the opportunity to host close to 300 of the top CEOs and founders of companies in logistics and technology at the BJSA Supply Chain Conference. And the attendees at that conference and speakers, which include CEOs and leaders of some of the companies on the page that you see, include best and brightest across lots of different areas. Giants like UPS, FedEx, DHL, mid-sized, high-growth companies like an NFI or a Kenco or Global Trans, companies that are stars on the tech side. You see, several in here at Truckstop.com, Lamasoft, Flex, Project 44, et cetera. And then also Fortune 500 companies whose heads of supply chain will come and speak at our event, companies like Nike, Office Depot, and others. So what I'm going to share with you is really a summary of some of the things that we learned from our annual gathering just a few months ago with leaders of these and other companies, talking about big issues in supply chain from a CEO standpoint. So what I'm going to do is over the course of the next 20 minutes, share with you some of the highlights of what we're seeing, what we're excited about, and what we're learning from some of the other best and brightest throughout the world of supply chain technology. So first of all, last year, I don't have to tell you, it was a crazy year for everybody, but for supply chain, COVID-19 was the biggest shock to aviation since World War II. So if you look at passenger volumes, which grew just about every year since 70 years ago, 66% decline, and the industry lost 118 billion, which was really the equivalent of well over a decade of profit. So a lot got wiped out. On the other hand, go to the next slide. The markets actually did tremendously well for supply chain. So we have an index at BGSA of the top 70 or so public companies in transportation, logistics, and software. And those are tracked across a series of categories, ranging from trucking to software to various others. And that category was up 26% last year, even better than the market as a whole. So why is that? Go to the next slide, please. You'll see within each of those different 9 segments, a variety of stories, but a couple things that stand out. LTL, parcel, and technology all did tremendously well, but the percentages don't tell the full story. If you go to the next slide, you'll see that in the world of actual value creation. So what I did here was I plotted along the x-axis, the different segments, along the y-axis, the percentage change in market value, and then the size of each bubble represented the size in enterprise value of each company. And the thing that stands out here is really the yellow column, parcel, the yellow bubbles, FedEx, UPS, and DHL, in aggregate grew about 40% last year and added about $110 billion of market value. That's enormous. Why is that? Well, fundamentally, it's because more online purchases and more last mile delivery, for which the primary beneficiaries were a big parcel. But there were other winners as well. LTL involved in last mile delivery, lots of software companies and some logistics as well. Next slide, please. And another way to look at this is sort of a heat map where the size of the rectangle represents the size of each market. And then within that, the size of each subcategory is the individual company. So parcel and logistics added the most value, of which UPS with 45% growth, but more importantly, in terms of raw dollars, added the most market value. But then you see little buckets of value creation throughout. Owens and Minor, for example, and healthcare, growth in healthcare logistics and PPE, of course. Go to the next slide. So a good question to ask someone that gets called nice things like Daniel said about me is, hey, Ben, that's great, but how accurate were you last year? Well, this is what we said last year. We thought recession, freight recession, trade war, and various other risks were on the horizon. And if you go to the next slide, you'll see we were right about a lot of that, but wrong about a few things. We were right about the China trade war. Mexico replaced China as the #1 trade partner. We were right about the surge in Amazon, and indeed Amazon recently bought 11 planes, added a hub in Cincinnati, added 57% growth to their freight. We were right that trucking bankruptcies spiked. We were wrong about the rebound, not knowing about the massive stimulus that would be triggered by government funding, which of course has propped everything up. We thought we were right about the market being overpriced, but yet again, stimulus support led to this massive spike. So I'd say we were right about some things and wrong about some other things. So now let's take a look at the future. Go to the next slide, please. A lot of things to be excited about: e-commerce, last mile, returns, cold chain, supply chain tech, and the market. So let's take a quick look at each of those. So first, e-commerce. We go to the next slide. So McKinsey and others have pointed out that COVID compressed 10 years into 3 months. If you look at e-commerce penetration as a percent of retail, in a decade, we went from 5 to 15% penetration. In 1 quarter, we went from 15 to over 30%. So massive growth. And that, of course, has had all kinds of downstream effects on supply chain. If you look at last mile growth, for example, the B2C supply chain, 41% of that has come from last mile. And that in turn has driven growth in lots of companies in that arena. So, for example, if you look at the growth in market size, you'll also notice a correlating growth in M&A activity. And in the last year, Forward Air buying Lindstar, Target buying Deliv, JB Hunt RDI, US Pack Freight, Costco Innovel. A lot of deal activity. We expect we'll see more of that for that very reason. Second key trend is in returns and reverse logistics. You buy something online and then it gets returned. So that's a category that's grown at 19% over the course of a decade. That growth we expect will continue for a lot of reasons. What people buy online tends to be returned at a much higher rate, 25% on average. Shoppers care about that. So 88% of shoppers check returns policies before they buy. 74% would switch brands if the returns policy was better. So this is something that matters. There's a real pain point for companies, whether in logistics, brands, or retail. Getting it right can be a huge profit center. And by the way, we at Cambridge Capital invested in a returns management company just 2 months ago called Reverse Logic. So we're putting our money where our mouth is. A third trend is cold chain. Cold chain's hot. So cold chain is the tracking Well, it means multiple things. It refers to pharmaceutical logistics, food logistics, and in this particular case, the tracking of temperature, location, and other dimensions for pharmaceuticals. At our conference in January, we got to do an interview with Stéphane Bancel, the CEO of Moderna, and we talked a little bit about what Stéphane and Moderna are doing in terms of their cold chain in support of the pharmaceutical distribution. This is a big area of importance because, first of all, most companies, 92% of respondents, like pharma companies, said they couldn't fully trust the data coming in from their tracking. So that's important because tracking temperature and location and ensuring compliance is a big deal for companies in the pharma world, where being out of compliance could mean that you could lose millions of dollars of drugs in transit. 99% of respondents say they're using manual processes for visibility and tracking, and 87% say they don't have full visibility into the last mile. So this is a pain point. This is an area where we expect to see more and more growth. Finally, what does that mean for the world of technology? There is a proliferation of spending and investment in the world of logistics tech. You can look at that in many ways. This particular chart shows 13 different buckets, ranging from digital freight to e-commerce to autonomous to drones to various other arenas. And a lot of companies on the page, a lot of companies achieving success. Many of the companies on this page are unicorns, some are soonicorns that are on deck. And again, the growth in this category has been tremendous. And that's been great for us as specialists investing in and working with some of the companies, among others on this page. The amount of money pouring in is really unprecedented. So supply chain technology has attracted $302 billion over the last decade. Last year was a record. Supply chain technology hit $52 billion. The freight tech portion of that was nearly $4 billion. This year is actually tracking for even more. So again, a lot of money coming into the space in pursuit of a lot of great opportunities. And the SPAC spike. So after a long period of time in which SPACs were viewed as a novelty, in the last year, a tremendous amount of money, close to 45 billion raised last year, and in total about 63 billion in dry powder. This number should be higher now. It's gone up every month. And all that money is sitting on the sidelines waiting to be invested. Some of that will go into supply chain. I know that some of the portfolio companies we have at Cambridge have been approached by SPACs, and certainly I expect that this year we'll see several SPAC mergers in the logistics and supply chain tech world. What's important to note is that 63 billion in dry powder really translates into about 300 billion of purchasing power, because your average SPAC will look to invest in or merge with a company that's significantly larger than they are. And so if a $200 million SPAC might look for a $1 billion value company with which to merge, so that resultant company, first of all, has 200 million, which is not that much higher than what they might raise in an IPO. And secondly, the SPAC sponsor equity is a smaller amount of dilution as a percent of the total when you've got a much bigger company. So really what that means is you could see $300 billion worth of companies merge into SPACs in the coming year. And if supply chain is a third of the overall economy, maybe there's close to 100 billion worth of public market activity in supply chain that gets fueled by this. So that's a big deal as well. Next slide, please. If you look across SPAC activity, you'll notice that while there's been more activity in TMT, really the tech world, tech and media, there's also been a lot of activity in the energy and sustainability realm, which is where many people would classify so-called green logistics, green supply chain, whether that's electric vehicles or otherwise. And so I think you'll see more companies in really both on the tech side as well as the green supply chain side. And that's good news for the supply chain sector. However, all that glitters isn't gold. Nikola is a good example of this. Nikola, of course, went public at a $10 share price, which is the way SPACs are typically priced. It spiked up 800%. and at its peak in the summer, around 11 months ago. It plummeted over the subsequent 6 months down nearly, I guess, 5x, 6x. And by the way, it's still valued at well, as of the date of this chart, 6 billion, despite having less than 200 grand of revenue. So not every company that goes public through this mechanism is going to be a good idea. As Ben Graham, the legendary value investor, said, in the short run, the stock market's a voting machine, but in the long run, it's a weighing machine. So you may see crazy spikes, you know, a GameStop being valued at 20 billion despite burning money, for example. But in the long run, the market's a weighing machine, and that means that over time, you would expect to see great companies that will be valued accordingly, and the opposite also true. So without commenting on what's fairly valued today or unfairly valued, I would simply say that there's going to be a lot of money pouring into the supply chain world, and great companies will be positioned to take advantage of that and succeed. Next slide. So a little bit about us, Cambridge Capital. We look for great companies at the intersection of supply chain and technology. The way we see it, three waves of growth in the sector. In the 19th century, value creation is all about the railroad. So you think about it, in 1869, a guy named Leland Stanford drove the Golden Spike into the ground in a place called Promontory, Utah. And he created the first east to west coast complete railroad that could go from coast to coast. Since then, there were many major fortunes built: Vanderbilt's, the Carnegies, the Flaglers, plenty of others. The next century, you could say, was all about the box. There's a great book by that name. Author, I think Robert Levinson wrote the book about how in 1956, Malcolm McLean took an old oil tanker and he modified it to be able to put containers on it. He put 58 shipping containers on that ship. It went from Newark to Houston, and he invented what we now know as containerization, and that fueled fortunes in shipping. By the way, the world we live in now, where Asia is the world's manufacturing hub, but the US and Europe do the majority of the consumption, that fueled fortunes for companies like Maersk and JB Hunt, but also retailers. Walmart doesn't exist the way it does today if Malcolm McLean doesn't invent the high volume, low cost form of global shipping that containerization ushered in. But today we're in this third wave, and that's the digital supply chain. And the Amazon effect has allowed us to see a huge new ecosystem of growth in all areas at the intersection of supply chain and technology. And that's fueling all kinds of winners. And I'll share a little bit about some of those themes on the next slide. Next slide, please. So some of those themes, these are some of the things that we look for here at Cambridge. E-commerce fulfillment. So the growth in e-commerce in turn drives demand for the logistics in support of that, and fulfillment companies are a beneficiary. Last mile. Last mile is a $115 billion sector. It's a huge piece of the supply chain, and people that can deliver innovation in that arena can produce tremendous value. Cross-border. So fulfillment, delivery of goods. You might be in Latin America and you want to buy something in the US. How does it get there? Cross-border supply chain becomes increasingly important. Predictive supply chain decisioning. How do I use AI to make better decisions and sift through all the data that I have? Pure play software, whether it's TMS, WMS, or otherwise. Man plus machine. So a lot of people have said that logistics is all about the man or the woman, a very manual process, and that software will automate and eliminate that. We don't believe that. We don't think it's man versus machine. We think it's man plus machine. So we think logistics companies that use technology will win in a competitive environment where after all, companies like C.H. Robinson and truck brokerage planning to spend over $1 billion on tech over the next 5 years. We think that's a great illustration. XPO, similar story, I think spent over 400 million in tech last year. And so smart logistics companies that spend more on technology to create more of a competitive advantage should win. Visibility, tracking, where's my stuff? Extremely important. Telematics, digital freight, digital brokerage. These are all areas of we believe long-term growth. And those are some of the kinds of themes that we at Cambridge Capital look for as we deploy capital behind great companies and great themes. So if you look at some of the segments from end to end in supply chain along the x-axis and some of the types of services you can offer along the y-axis, you can plot these themes and look at companies that are winners in some of these different areas and companies that we at Cambridge have invested in. Liftit and last mile logistics in Latin America. XPO really is a tech-enabled supply chain provider going end to end. EcoSquid, now Reverse Logics and returns. Bring and Grand Junction in especially area of last mile for e-commerce. These are examples of places where we see companies that are building businesses that reflect those themes. So in closing, what we look for at Cambridge, we look for great companies in markets with those kinds of tailwinds, where they're using differentiated technology led by businesses with outstanding management, that have a strong market position that they can build off of. We're generally writing $10 to $50 million equity checks, majority or minority, in support of businesses where we think there's an opportunity to build billion-dollar potential throughout all areas of supply chain. So that in a nutshell is what we're doing to put our money where our mouth is in support of the themes that I've just described. We have a team that we're proud of that's very focused on this. I'm not going to spend a lot of time on us. I'll simply point out that part of what we've tried to do is combine investment expertise. My partner, Matt, for example, deployed over $1 billion in places like Insight and Macquarie with operating expertise, where partners like Isa, Dave, and Remus have been successful in building major companies, whether multi-billion-dollar businesses or divisions of multi-billion-dollar businesses. And I think that combination of investing and operating is vital. Next slide, please. Meanwhile, on the advisory side, we've continued to work on lots of deals with lots of great companies in all areas of supply chain, typically mergers and acquisitions. We can skip this slide. It shows a little bit about folks that have supported us in our event. So with that, I'm going to stop. I'd be happy to open this up for questions. I know Daniel, as our fearless moderator, will take it from here.
Yeah, thank you so much, Ben. Really appreciate your presentation and information. Very insightful. So all those in attendance, I've been looking at the Q&A. We haven't yet had anybody submit a question, probably because they were fully leaned in listening to what Ben was sharing. So I want to invite our audience members, if you have a question, go to the bottom of the Zoom webinar and you'll see the little button that says Q&A. Go ahead and click that and you can submit a question there, and that will allow us to ask Ben whatever's on your mind. In the meantime, while we're waiting for some questions to pop up, I have one for you, Ben. So this is a little bit compelling to me. You had shared the pharma visibility slide that said there was a gaping hole in terms of access to trusted information. And I think of the pharma industry as having probably the most invested into things like real-time visibility because of government regulations and things of that sort. So maybe you can expand upon that. Why do you think that particular, like the pharma industry, is lacking in terms of visibility, and what are they doing about improving that?
Great question. So why is the pharma industry lacking in visibility, and what are they doing about that? Well, first of all, the pharma industry is in some respects the most advanced when it comes to visibility, and yet that tells you something about the state of the industry as a whole, because if the pharma industry isn't getting what they need, it tells you that there's probably an opportunity for the rest of the market too. There are some great companies that have focused on this issue of visibility and tracking for the cold chain. Cold Chain Technologies is one, which is originally center of gravity on the packaging side. Sensitech is another, and there are plenty of others too. The issue is that, first of all, you're only as strong as your weakest link, right? So you might be let's say Moderna, for that matter. And you might be working with dozens of different logistics and supply chain companies, dozens of different suppliers and hundreds of different origin destination pairs. Maybe 90% of your suppliers have sophisticated technology, but a few of them don't. Well, guess what? It only takes one break in the process to hold everything else up. So it's interesting. Sensitech, for example, is great technology, but not everybody is spending the money on it. So I think there's an opportunity for somebody to provide a lower cost, easier to adapt system or solution that everybody, including the weakest links in the chain, can provide. Now, there are companies that are looking at that, focused on that, and developing that, and maybe some of them are on this call, and we'll want to address that. But I think because you're only as strong as the weakest link, there are lots of places, particularly in emerging markets, where you just have a gap in the supply chain, and that really presents an opportunity for low cost, easy to use, simple systems. So I think that's number one. Number two is you might be capturing the data somewhere, but it might not be getting shared. So there's also a need for what's called glass pipeline. I want to know everything in the supply chain and be able to view it, manage it, and act on it. That's important. And then number three is the ability to take instant corrective measures. In other words, maybe I know that I've got a pharmaceutical shipment that's on a truck and it's going through Texas in the summer, and the AC unit gets overpowered. Okay, well, if the AC unit gets overpowered and the temperature spikes from whatever, 50 degrees to 80 degrees, you might quickly find yourself in a position where you're out of compliance. And if you're out of compliance, you might have to scrap millions of dollars of pharmaceuticals that are in transit. So what you really want is, the second that happens, you want to be able to call the driver and say, pull over and find a way to fix the problem, or get some emergency AC repair on site, or otherwise have instant intervention. So part of this is the weakest link. Part of this is full visibility and analytics, and part of this is the ability to take instant corrective action. Those are some of the problems that I hear when I talk to people running major organizations and focused on the cold chain issue. So I think all of those present opportunities, both for existing companies and maybe for startups too.
Great, thank you, Ben. Really appreciate your perspective on that. And we've had a number of audience submitted questions. So thank you everybody for doing that. I'm going to jump into some of these and see what we've got time for. But first, Cryptomania aside, can you share your thoughts on the role of blockchain and how that might impact this space going forward? Yeah.
So blockchain, and I'll try to make these shorter answers, knowing the volume of Q&A here. I believe there's a big opportunity in blockchain, but I also believe the ecosystem for supply chain is ideally suited, but there are certain specific cases where I think it'll make more sense. There's a reason why you're seeing it for things like bills of lading and international shipments, where something might have to get printed or produced multiple times throughout the journey of something from origin through destination. So yeah, Cryptomania, no doubt, is gripping the markets right now. But if you separate what you think about the price of Bitcoin with the value of blockchain, I think there's real value and real application, particularly in areas where tracking from the beginning matters. So again, I think for international, for bills of lading, for tracking the origin of something, if I'm Chipotle and I've got an E. coli problem and I need to be able to trace it to a specific farm in northern Mexico, that data and the blockchain ability to record that can be very valuable.
Great, thank you for that. There's a question about the fractionalization, or how we're separating out the different modes within. I know you focus like last mile, the warehouse, and that slide, but how does the fractionalization of supply chain technology, does it cause concerns, or does it cause any concerns looking at the fractionalization of supply chain technology, or is it a view to look at it as consolidation?
Well, I think when you say fractionalization, Matt, thanks for that question. I see. I guess there are a couple of ways to look at that. You could think of that as a fragmented series of modes: truckload, LTL, air, ocean. You could think of that as fragmentation in terms of geography. Like I'm using someone in Florida, someone in New York, someone in Texas. You could think of that as fragmentation in terms of kind of different steps in a supply chain process, right? Transportation, warehousing, et cetera. And that absolutely creates challenges, but also opportunities, right? So it's interesting. I had a conversation last Friday with the chief supply chain officer for a $6 billion construction company. And he said to me, Ben, my biggest problem is I really want to have a holistic view of everything. Because when we have a project, if one thing is delayed, it can screw up, everything else. Kind of like the point about you're only as strong as the weakest link. So said I'd really like to have a system that everybody connects into so that all the suppliers know like everything's got to show up on Thursday and I can track it in advance and know where everything is, regardless of the mode or the underlying product. It all comes through the same system. So yeah, I think there's an opportunity, first of all, from a data standpoint to solve for that fragmentation. And then secondly, from a services standpoint, fragmentation and consolidation is one of the reasons why XPO has been so successful, buying and integrating multiple logistics companies across truck brokerage, freight forwarding, warehousing, and other areas. So I think there's opportunity on both sides of that.
So I'm going to talk about this question that's in manufacturing supply chain, demand is a function of the requirements driven by product design. Do you see an increased trend to bring supply chain transparency upstream to engineering teams where they can have an impact making more informed design decisions, hopefully to reduce disruptions in supply chain? I think of this from each company is trying to optimize their individual supply chain, or even a transportation manager or a warehouse manager might try to optimize their individual silo of supply chain. But I think if companies could, and if it were possible to have a holistic view of supply chain, then it would benefit a lot more stakeholders versus that siloed focus. But I think this is an interesting question. If it can have transparency upstream to even the design, then that could bear significant impacts. But what do you see as far as trends in that?
Yeah, so it's true. My friend Brian likes to say the world is a supply chain, and this question is a great illustration of that. So yes, I definitely think there is a need for bringing supply chain transparency upstream to engineering teams. You'd love for engineers to know that what they're building fits what's needed on a downstream basis, but that's a really hard problem. It's hard because if I'm an engineer and I'm building a product, how do I know? I mean, there's so many contingencies downstream. What is it that I could be planning for? I mean, for example, maybe I'm building a product and I'm worried that there's another, Suez Canal shutdown. Well, my design isn't going to help with that. But maybe if I have a product where there's more capacity for 3D printing, in other words, imagine that I'm manufacturing, auto parts and I'm making them in China. And it's a lot cheaper to make them in China than it is in the US. But maybe I build in some flexibility. Maybe I have some 3D printers in the US, or maybe I just have a manufacturing process that I have a little more raw material that I could ramp up accordingly. Maybe that's one way to solve it. Maybe another way to solve it is to do what's called a postponement strategy, where you manufacture something relatively consistent and then you postpone customizing it until the very last step. So in other words, maybe the core manufacturing is in China, but I'm postponing the high value added customization for the last mile, last step in the US. And as a result, maybe I could afford to build up more safety stock, and so you could get really complicated, really quickly around this. So I guess what I would say is, yes, there's an opportunity to try to bring transparency upstream to the engineering team, and maybe Xometry is a good example of a company that's doing some creative things there. but I think it's a hard and confusing problem to solve. So there may be people who are smarter about that than I am.
Thanks, Ben. I see a few people have asked questions regarding Cambridge and investment. So I'm going to choose this one. It says, thanks for a great presentation. It's not clear the type of investment type of the fund, mid-late stage VC, growth equity, logistics. Can you elaborate more about the type of investments that Cambridge is involved in? And how do you work with companies like Moeco and Plug and Play?
Definitely. And thank you. Thank you for that. So Cambridge Capital invests in both growth capital and buyouts. Why do we do that? Well, really, we tend to be a lot more involved than just kind of your average venture capital firm. Your average venture capital firm makes a lot of small investments, knows that a bunch of them will fail, a few of them will go sideways, but one or two home runs makes the fund. And that's great. And there are a lot of great venture firms out there. Our philosophy is to be more selective, pick a smaller number of companies, and then really get involved in helping those companies. I mean, as an example, we invested in Reverse Logics and returns management a little over 2 months ago, and we've already introduced them to more than 40 companies. C-level introductions to major logistics companies, similarly with Bring, with Lifted, with others. A pretty active role in helping in support of everything from recruiting to commercial growth to strategy to other areas. That kind of work takes a lot of time. And so we're not like, some of those venture firms where a partner might be on, 10 different boards. We're just a lot more selective, and then we put a lot more time into supporting those companies. So if you're going to do that, you have to be at a later stage in order to warrant the magnitude of that. We're not investing with the hope that half of them fail, but a couple of home runs will make the fund. We invest with the expectation that they're all going to succeed, and it doesn't work that way in reality. But that's the approach. That's the idea. So we invest 10 to 50 million, typically in companies on the growth side that are doing 5 to 30 million of recurring revenue, or on the buyout side, 5 to 30 million of EBITDA. And what we look for really are, number one, companies that have tailwinds behind them, like some of those major themes like e-commerce, reverse logistics, cold chain, et cetera. Number two, with outstanding teams, because fundamentally we're backing people. Number three, where we think the businesses are already clearly successful in their own right, have real traction. And then number four, where we think we can add something material to help. And when those, when the fit lines up on those dimensions, we tend to be in a great position to really help. And again, guys like Bring, Reverse Logics, Lifted, and others are illustrations of that. So we love early stage, firms. Plug and Play does a great job of identifying great early stage companies that they help. And we like being in a position where we can be a partner for companies that graduate from the early stage to the late stage, and that's spectacular. Moeco, I mean, look, we love what you guys are building, and certainly, again, from a strategy standpoint, things that match up with our criteria and our size and stage, are a perfect fit. And so, and to the extent that there are people, as I see there are other questions about this in the Q&A session, people that are interested in reaching out, you're welcome to reach out to me. Email is always the quickest. I'm, ben@cambridgecapital.com, or you can find me on LinkedIn or Twitter. But while we're all busy, we strive to be responsive and respond same day on virtually everything. So by all means, feel free to reach out.
All right, let's talk about trends that you think are the most exciting. So this question says, what trends and solutions do you think are the most disruptive and excite you the most? And this person's also asked, are they applicable in emerging markets such as Latin America?
Yeah, so a couple things. Last mile is an area that we're super excited about, and it is very applicable in Latin America. And in fact, Lifted is a company we invested in last year that's doing just that. And the premise for Lifted is solve the problem of last mile, deliver a great supply chain solution, bring automation, and deliver at the same global kind of Fortune 500 standards that that major companies expect, here in the U.S. and worldwide. I mentioned that because I think part of what Lifted is doing that's special is they're not only bringing great technology and entrepreneurial drive and enthusiasm, but they're also deploying at a very high professional standard. Jim Van Leenen, the CEO, who is a black belt Six Sigma at GE and understands the corporate side as well as the entrepreneurial and logistics side, is a good illustration of that. So I think last mile is one great area. I think e-commerce fulfillment, another. We've seen some interesting companies, although we haven't invested in any in Latin America in e-commerce fulfillment. But as a category, we think it's certainly a great one. Cross-border. I mean, there are some interesting companies that we've seen in cross-border. Interestingly, one big area. I'm here in South Florida, Palm Beach, not far from Miami, and there are plenty of Latin American consumers who want access to U.S. markets. And if you want to buy something from Amazon, you may use a cross-border logistics and supply chain partner to facilitate that. So that's an interesting illustration of a third trend. So I think all those trends are relevant to Latin America and frankly, many others. All 10 of the ones that we alluded to earlier, they're global trends. They're relevant, Latin America and worldwide.
Awesome. Thanks, Ben. This question is talking about friction caused by inbound quality disruptions. So if somebody's working with a lot of suppliers or vendors, what are your thoughts in terms of managing vendor compliance within distribution networks?
Yeah, so this comes back to the point about being only as strong as your weakest link, right? So friction with inbound quality disruption and distribution networks. So the construction company that I mentioned, that might have a dozen vendors who all have an inbound delivery, and if they're not all there at the same time, you're going to miss your deadline, right? So that's a huge friction point or pain point. I think it's an opportunity for TMS companies. I think it's an opportunity for collaborative software companies. I think it's also an opportunity for visibility and tracking companies. So that's one of those real world issues where being able to knit all those solutions together is important. And it's not just about the most sophisticated solution. It's also about the most practical one that gets widespread adoption.
Yeah, and in that example of the construction company, if they're missing the foundation piece, everything else needs to be built on it. But maybe it's a component that they're banking on, and then they can suddenly shift just the order of the construction build. So you need enough visibility to see and make reactions to a construction project or whatever that supply chain example might be. Thanks for that question, Eric. I think we have time for maybe one more question. So there's a talk about the value network. So follow on the supply chain concept to the value network you were referring to earlier. How do you see the evolution of the supply chain moving towards an always on, always connected network? It seems to be a natural progression, yet some people are a little bit scary to think about that.
Okay, so the question is about an always on, always connected network. Look, yeah. I think a big part of that is it's a visibility question. It's a tracking question. People want to know, where's my stuff? So I guess I'm reading Richard's question, and I'm not sure if Richard's referring to the visibility piece or another piece, but I interpret that as the fact that consumers want to know and customers want to know at all times, where's my stuff? Amazon has trained us. Amazon has spoiled us all to expect that, right? So what's interesting is what Amazon trains people to do ends up becoming expected everywhere else, right? My user experience when I buy something on Amazon becomes what I expect when I buy something on any other site, whether it's a business site or a consumer site. Similarly with tracking, if I know where my shipment is at all times on an Amazon purchase, it's going to be the same thing that I expect anywhere else in my supply chain. So I think that means moving towards a world where, number one, there are more sensors tracking everything. And number two, there's better software that helps tell us where anything is. And then number three, also more proactive alerts and notifications. Something's going to be late, what do I do about it? So all of that means the category of visibility becomes more and more important.
That's great. Yeah. And I come from a company that's constantly talking to organizations who need visibility, and we offer a solution for visibility. And it's amazing how invested supply chain stakeholders are in solving this problem. And I still am kind of wowed by the slide that you had earlier in your presentation, that the pharma industry, who I view as the leader in this category of investing in visibility, is still lacking. And that just tells me how ripe the rest of the marketplace and businesses and supply chain stakeholders, really it's fertile ground for them, because even the leaders in the space, being pharma, are needing solutions. So I think it's definitely exciting. We're out of time, and we still have some great questions. So I'm going to hand it over to Plug and Play. I just really want to thank the audience and everybody who attended. This was really great to have Ben here and share his perspective and thoughts. So I want to thank you, Ben. I'm going to hand it over to Sophia from Plug and Play. Thank you.
Thanks, Daniel.